Imagine trying to swim against a powerful river. You can do it, but it requires enormous effort. Now imagine swimming with the current. Everything becomes easier. The stock market works the same way. One of the biggest reasons beginners lose money is simple. They fight the trend. They buy falling stocks. They short rising stocks. They try to predict reversals instead of understanding what is actually happening. Professional traders know something different. The trend is not everything, but ignoring it can be extremely expensive. Today, you're going to learn trend analysis. By the end of this lesson, you'll understand how professionals identify market direction and why trend analysis is often the foundation of successful trading. Let's begin. A trend is simply the general direction of the market, nothing more, nothing less. Many beginners overcomplicate this concept. A trend answers one question: which side currently has more control, the buyers or the sellers? Every market is usually doing one of three things: moving up, moving down, or moving sideways. That's it. Almost every chart on Earth can be placed into those categories. Let's start with an uptrend. An uptrend occurs when buyers are consistently stronger than sellers. But how do we identify it? Look for two things: higher highs and higher lows. This is the heartbeat of a growing market. Imagine a stock rises from 50 to 60, then pulls back to 55, then rises to 70. Notice what happened. The highs became higher, the lows became higher. Each step is slightly higher than the previous one. The stock advances, pauses, and advances again. Professional traders understand this. Beginners often panic during normal pullbacks. Professionals recognize that pullbacks are part of healthy trends. They use these moments as opportunities, not as reasons to flee. It is about structural integrity. Now let's discuss downtrends. A downtrend occurs when sellers control the market. The structure is the opposite: lower highs and lower lows. Imagine a stock falls from 100 to 90, then rebounds to 95, then falls to 80. Sellers remain in control. Many beginners make a dangerous mistake here. They believe a stock is cheap simply because it has fallen. But price alone does not create value. A stock can always fall further. Professional traders respect the trend. They don't argue with reality. Now let's talk about sideways markets. Sometimes buyers and sellers are equally strong. Price moves back and forth inside a range. This frustrates many traders, but it also creates opportunities. It is a battle of attrition. Think of a boxing match. Neither fighter dominates. Eventually, one side wins. And when that happens, a powerful move often follows. This is why professional traders pay close attention to consolidation periods. Most major trends begin after a sideways phase. Trends do not last forever. Every trend eventually weakens. But beginners try to predict changes too early. They see one red candle in an uptrend and panic. They sell, then the trend continues higher. Or they see one green candle in a downtrend and buy. Professional traders look for evidence, not hope. They wait for the structure itself to change. A true reversal leaves clues. Lower highs begin appearing in an uptrend. Higher lows appear in a downtrend. Professionals listen to what the market is actually saying. Not all trends are equal. Strong trends have healthy pullbacks and consistent momentum. Weak trends show erratic price action. Ask yourself, how healthy is this trend? A healthy trend attracts participation. An unhealthy trend creates confusion. Large institutions look for established trends because probability is higher. They follow strength. Money attracts money. Confidence attracts confidence. This explains why strong trends often last longer than most people expect. Momentum is a powerful force. The greatest lesson about trends is psychological. The market does not care about your opinion. It only reflects what participants are actually doing. Professionals become attached to evidence, not predictions. Their loyalty is to reality, not ego. Before entering any trade, ask yourself three questions. What is the trend? Who is in control? Does my trade align with the trend? These three questions can eliminate many poor decisions. Trend analysis is about understanding the present. Today's challenge: open 5 charts. Identify an uptrend, a downtrend, and a sideways market. Mark the highs and lows. Train your eyes. Recognition is one of the most valuable skills you can develop. It separates traders from gamblers. Tomorrow we move into risk management, the skill that protects your capital and keeps you in the game. Subscribe to Wealth Entertainment 21. A trader who understands the trend has an advantage. A trader who understands risk has a future. I'll see you in episode 7.